Thank you, Alison. Good morning, everybody. We've delivered underlying profit before tax on expectations at 546 million, up 11.9% on last year. This includes the 53rd week, which contributed 14 million pounds of profit and accounted for 2.8 percentage points of our profit growth. I will only make reference to the 53rd week on this page, but it is highlighted on the following pages and also in the appendix for your detail. Looking at profit from operations, we had a good performance in both businesses. Hotels and restaurants profits in the UK and Ireland was up 11% to 451 million, and international hotel losses improved slightly to 4.6 million. Cost of profit was up 15.8%, led by the UK, where profits increased by 14.9%. In Costa International, we made a profit of 2.5 million, up from just over 1 million last year. Within this, we had a good growth from our profitable international franchise business, in our store contributions in China, and we made positive progress in Poland following the conversion of the stores to the Costa brand. This was partially offset by the investments we are making in the startup businesses in Costa Express in Canada and Costa Retail in Singapore and France. The profit was driven by good revenue growth across all of our brands. Premier Inn sales were up 12.9%, with UK like-for-like growth of 4.2% that benefited from both an increase in the RevPAR of 2.6% and our hotel extension programme, which also added around 2% to our like-for-like sales. Within RevPAR, regional RevPAR was up 3.4%, and our London RevPAR was down 0.4% in a weak London market in the second half of the year. Restaurants' total sales were up 3.5%, with like-for-like growth of 0.8%, ahead of our market competitors. And Costa finished the year with sales up 15.9%, UK equity like-for-like sales up 2.9%, and total international sales are up 13.7% at constant currency. This slide shows the margin percentage progression over the year. In hotels and restaurants, the margin percentage increased by 0.3 percentage points to 24.5%. Within this, we benefited by 2.7% from the like-for-like growth from RevPAR and extensions, and 1.1 percentage points from our efficiency programme, particularly around labour productivity. Inflation and the investments we made in technology and refurbishment accounted for 1.4% and 1.2% respectively. And as we increase the leasehold proportion of our predominantly freehold estate, we naturally increase the rent charge in our P&L, with leasehold hotel rooms making up 57% of our openings over the last 2 years. This additional rent, combined with higher rates, impacted our margins by 0.9%. In Costa, the margin percentage was flat at 13.9%, with margin growth in the UK's underlying business due to our like-for-like equity and franchise performance, and as we build scale, offset by investments in the new formats and in IT. Turning to profit after tax and exceptional items, profit after tax was up 13.5%, with our effective tax rate reducing from 21.5% to 21.3%. Profit after a £26 million charge for exceptional items was up 5.8%. The exceptional charge was predominantly, as laid out in the interim results, and related to onerous releases, which predominantly on historically disposed businesses, and the write-off of IT software, which no longer has future economic benefits. A full breakdown is laid out in the appendix. We generated strong cash from operations of 782 million, which both supports our capital investment and also provides us balance sheet flexibility. This strong cash flow, in turn, together with our borrowing facilities, has provided the funding to invest £215 million in product improvement, maintenance and IT capital, and grow our expansionary capital to 510 million. And I'll come and talk about that in a moment. As we capitalise on the growth opportunities, our cash outflow for the year was 327 million. The cash outflow increased our net debt at year-end to 910 million, compared to our total funding facilities of around 1.7 billion, giving us good headroom. As shown on this slide, we look at our debt in its three components: net debt, our pension deficit, and lease contributions. Our pension deficit net of tax reduced from 476 million to 259 million due to the 84 million company contribution and also the increase in the liability discount rate. As we build towards our milestones, we remain committed to maintain our competitive advantage by managing this overall debt to retain a strong balance sheet. To this end, we finished the year with our adjusted net debt to EBITDA slightly down to 3.1 times, compared to our objective to manage to a ratio of less than 3.5 times, again giving us comfortable headroom. This commitment to a strong balance sheet in turn provides us access to a diverse source of funds. During the year, we took advantage of this and increased our bank facilities from 650 million to 950 million pounds, with a 5-year maturity and the option to extend for a further 2 years. And we also successfully issued a 450 million pound 10-year bond. This access to funding gives us tremendous flexibility and supports our organic growth plans. Going into our cash capital expenditure in more detail, at the bottom of this page you can see that this year we spent £725 million, in line with the guidance given at the beginning of the year and up £160 million on the previous year, with the increase predominantly in hotels and restaurants. Looking at this in more detail, hotels and restaurants expansionary capital increased 122 million to 455 million. Firstly, we continued to purchase UK freehold properties for future openings, spending 165 million. Secondly, we built and opened a record number of hotel rooms, including just under 1,500 extensions. And lastly, we increased the investments in Germany as we secured 2 new freehold sites last year and opened Frankfurt. In hotels and restaurants, we are also improving our customer experience, continuing to widen the gap with our competitors, with an investment of £192 million on product improvement and maintenance. This included £91 million on room and restaurant refurbishments, £58 million on property maintenance to protect our assets, and £43 million on upgrading our technology and digital systems. Costa's cash capital expenditure was 103 million, with 55 million on expansionary capital as we opened new coffee shops and installed new Costa Express machines, and Costa spent 48 million pounds on product improvement, a significant part of which was upgrading Costa stores and building our new roastery. Return on capital is a prime focus for Whitbread. Costa's returns in the middle of the chart increased over 3% to just under 50%. And on the left, hotels and restaurants returned remained a good premium to our cost of capital at 12.9%, but were down at 0.6 percentage points year on year. This was due to the £380 million investments on our balance sheet we have made in future hotel openings in the UK and Germany. Excluding this future capital investment, hotels and restaurants returns would have been 1.5 percentage points higher at 14.4%. On the next 3 slides, I've laid out some considerations for 2016-2017. Looking at hotels and restaurants, SDR is currently forecasting the market RevPAR to grow by 2.6%, with sales slightly down in London and continued moderate growth in the regions. We believe these to be reasonable assumptions. Although the London market has been down around 3% over the last few months, and with the timing of Easter, we are not seeing any material change to this trend in forward bookings. We do expect it to pick up once we get into the busier demand months as we move away from the Easter period. When thinking about Premier Inn's RevPAR, there are 2 moving parts to consider. Firstly, we benefit by around 0.5% from the greater proportion of our openings in higher RevPAR London. And secondly, our extensions will grow our total like-for-like sales, but will dilute our RevPAR by around about 1.5% as we add capacity to existing hotels, and with a greater impact in the quieter demand quarters, first and fourth quarters. And last year, we opened a record 5,461 hotel rooms, of which over 2,000 were in the last month of the year. Although we have the pipeline and the capability to replicate this again, this workload added unnecessary complexity and cost and does not help us deliver the best customer experience when the hotels open. To avoid this next year, we are being more practical with our phasing and setting our plans to open 4,000 to 4,500 rooms with no impact on our longer-term ambitions of 85,000 rooms by 2020. And as mentioned in the February trading statement, we plan to spend an incremental net P&L investment of £9 million in our hotels, improving our capability and infrastructure. I've also laid out our rent and depreciation forecasts for both hotels and restaurants and for Costa. Turning to Costa, again, as mentioned on the February statement, we are planning for 2 to 3% like-for-like growth and around 230 to 250 store openings. With the continued success of Costa Express, we're also planning around 1,000 new machines and with a growing proportion internationally. And lastly, as previously advised, we plan to spend an incremental net P&L investment of £6 million in Costa. On this slide, I've laid out the capital for planning assumptions for the next year of around 700 million gross spend. From this, you can see that in hotels and restaurants, we will continue to invest in our milestones, our product improvements, IT, and growing our German pipeline. In Costa, given the high returns, in the next 2 years, we will increase this spend from around 100 million to 140 million as we increase the retail and express openings, spend more on refurbishment and improving the proposition in our core UK stores, and invest in digital platforms and the new roastery. Given the investments we have made in freehold and hotels and restaurants, we will also look to capitalise on the opportunity they provide, and we will look to recycle some of our freehold investments through sale and leaseback transactions, resulting in a net spend of around £600 million in the year. Briefly turning to current trading. We have only had 6 weeks of trading, so very early indications in the new year are that Costa has had a good start to the year, and hotels and restaurants are growing share in a weak hotel market. I would point out that trading comparisons have been impacted by the timing of Easter, and we will have a much better and more relevant view on the 21st of June at our Q1 trading statements. But at this early stage, we're confident of further good progress being made across the business this year. Before I summarise, following the recommendations to reduce reporting frequency from both the FRC and many of our major shareholders, the board has decided to move to trading announcements 4 times a year, down from the current 6 times a year, including the interim and full year results. This will enable us to focus more on the quality of our reporting and on our long-term strategy. We will also hold a Capital Markets Day for Costa and Premier Inn in November and will advise you of a date shortly. So in summary, Whitbread has had a good performance in 2015-16, with underlying earnings up 11.7% and return on capital of 15.3%, a good premium to our cost of capital. With a continued structural opportunities, disciplined capital management, and focus on our customers to build a bigger and better Whitbread that extends our market-leading positions, we will continue to underpin our resilient business model and deliver good shareholder value. Alison and I are now happy to answer any questions. Thank you.